The word Vijay means victory, and we've seen a number of famous personalities carry this name. But one person who is not that famous but has won the hearts and minds of informed investors all around the country is Dr. Vijay Malik, in what can be described as a typical story of
मेरा बेटा डॉक्टर बनेगा.
Okay, this was slightly exaggerated, but Dr. Malik did complete his MBBS. He worked for a few years as a medical officer, even tried his hand on cracking civil services before he realized finance and investing is where his heart is. And in 2016, he became a full-time equity investor, and fortunately for us, a wonderful teacher who explains so eloquently using workshops, courses, and definitely his blog. In fact, I highly recommend you read every article on his website, and if you aren't impressed, then book an appointment with a good doctor and please get yourself checked up. Now, of the 500 odd articles that are there on the website, I'm going to discuss the one that's titled Final Checklist for Buying Stocks. Understandably, these are a set of rules and guidelines, and I'll try my best to put them on a screener to see which companies might ascribe to Dr. Malik's way of selecting stocks. I'm sure you learn a lot in the process. So let's begin. Dr. Vijay Malik breaks down his checklist into 4 major categories that cover a few financial metrics, business parameters, valuation-related numbers, and finally the management of the company. Let's start with the financials, and there are 8 variables here. The first is sales growth, and we've seen in a number of videos that the top investors do seek at least a 10% here. However, Dr. Malik prefers it to be 15% over a period of 7 to 10 years, and there has to be some consistency here with no big spikes or drops. Now, when I apply this on a standard screener, it gives me 274 entries, which is a pretty decent set of companies for us to work with. The next variable is profitability, and the checklist needs a net profit margin of at least 8%, which knocks down our list to 111 companies. The third factor in the list is the tax payout, and Dr. Malik prefers companies whose tax rate is closer to the general corporate tax rate. And while the good doctor takes it at 30%, I think recent updates in the tax code makes 25% a more delectable number, and our list is again down by a half. Personally, I thought this rule was a bit harsh as it throws off some decent tax-paying companies who might be enjoying some sort of tax holiday or might have previously accumulated losses in their books. Anyways, the fourth metric is interest coverage, which is a simple and effective way of explaining how well a company can service its debt. So higher is better, and the checklist requires this number to be at least 3, which leaves us with 42 companies. The fifth variable is the debt to equity ratio, and if this number is less than 0.5, then Dr. Malik feels the company is not over leveraged and is therefore not risking a dent in its profits or even bigger problems that often take shape during downturns. Next up is the current ratio, which helps an investor assess the company's ability to pay its short-term liabilities with short-term assets like cash, inventory, and receivables. It's an important variable, and the checklist requires it to be at least 1.25 times. The seventh factor is around cash flows, and point blank, Dr. Malik needs the company to be consistently generating positive cash flow from operations. As a result, I looked at this across a 1, 3, and 5-year period, and the short terms are listed to 23 companies. And the final financial metric is the comparison of a company's profit after tax with its cash flow from operations. Notice here there are no numbers that Dr. Malik has given, but just to understand where he's coming from, when a company's cash flow from operations are in close proximity to the net profits, then it's an indication that the company's reported earnings are backed by actual cash inflows which have been generated through its core operating activities. The reverse, that is, if the operational cash flow is very divergent from the net profit, then it probably means an aggressive revenue recognition policy, which I explained with an example in a previous multi-bagger video, or it can be due to working capital changes like the company extending lenient credit terms to its customers. And it can also mean a high percentage of non-cash items like depreciation and amortization, which are subtracted from the net profits but do not directly impact the cash flows. I can do a separate video on these cash flow scenarios, but on a screener and incorporating what Dr. Malik is saying, I'll say we're looking at companies with not more than a plus minus 20% deviation in their operational cash flows and the net profit numbers. So this concludes the 8 financial metrics in the checklist, and what started with a universe of 4,300 plus companies is down to just 11, and I'm purposefully removing the last entry from this list because of its low market cap. So these 10 companies here comply with Dr. Malik's stock picking rules with consistent sales growth, a reasonable to high net profit margin. They are compliant on their taxes. They have a high interest coverage ratio, which is good, a manageable debt to equity ratio, enough financial resources to cover their short-term obligations, a positive cash flow from operations, and there is a proper alignment between the company's net profits and its operational cash flows. The next set of metrics relate to the business and its operations, and there are 5 of them. The first is a comparison with industry peers, and we want a company whose sales growth is higher than its competitors because it means this company has some sort of economic moat that it is utilizing. For example, PI Industries is into the agrochemical sector and competes with companies like UPL, Sumitomo Chemicals, Rallis India, and Sharda Cropchem. Noticeably, PI Industries has not only grown its sales consistently, but it has also done it at a faster clip as compared to the peers, which is a big plus in our checklist. I mapped the same for the other companies as well, and barring a couple of them, our shortlisted companies were generally ahead of their peers. The second variable is an increase in production capacity and sales volume, and all 10 companies seem to be doing well in that context, although I must add that finding the delta in production capacity was a bit difficult. The third factor in Dr. Malik's list is conversion of sales growth into profit growth, and essentially we're trying to see if these two variables are in alignment to each other. So it should not be a case where the sales are flat but the profits are growing, and definitely it should not be what we are seeing with Sharda Cropchem, where the sales have been growing a lot faster as compared to the profits. The fourth variable is the conversion of profits into cash, and I think this is a repetition from point number 8 in the financial metrics that we discussed earlier. Anyways, there is no harm in saying it again, and all 10 companies in our list have their profits and cash flow from operations within proximity to each other. And the fifth and final variable of this category is the creation of shareholder value from the profits retained, which also means that the company's increase in market cap over the last 10 years has been greater than the increase in retained earnings. Now, I had to do some parts of this manually, and from a list of 10, only Signity Technologies seems to have grown its market capitalization at a slower pace as compared to its reserves. Okay, so to put it all together, and if I really need to force rank it, then this is how my top 10 would look like. And as a structure, as a framework, this definitely puts the investor in the driver's seat. Speaking of which, I'm very happy to inform that seats for FISDM's Ignite event in Jaipur are filling up fast, and we've already crossed over 100 registrations. The event is being held at Hotel Ramada on the 16th of September, and this will be an on-ground live trading and investing workshop that will include 4 masterclasses of 75 minutes each, with renowned traders and technical analysts sharing their strategies, techniques, and tips. This full-day event will give you enough time to network with the experts, even have one-on-one discussions, and every participant also gets a BSc certification. So if you are in Jaipur or somewhere around, then do put that Saturday to good use, and don't forget to use the code SKN60 for a 60% discount on the ticket price. Right, so next up is management analysis, and very quickly, here's what an investor needs to be looking at. Firstly, one needs to do a background check of the company's promoters and directors. Then the company's succession plan needs to be examined for fairness and capability. The promoter's salary should not be tangential to the profits of the company. So if the profits are declining, then the promoter's salary should not be going up. Fourthly, the company should have shown good project execution skills. The dividends should have consistently increased over time, and barring Sri Ganesh remedies, everyone else has been upping their dividend per share. Then, as per Dr. Malik, a high promoter shareholding is good, and there should be at least 51%, which is the case for most of our 10 companies. Number 7, there should be some insider buying, that is, the promoters should be buying more shares in the company. And finally, foreign institutional shareholding should be low, which is exactly the case with our 10 companies, and the FII holding is less than 20% in every case. The fourth and final category in Dr. Malik's checklist is, of course, valuations, and there are 6 different metrics to look at. The first one is the highly popular P ratio, the price earning multiple, and this can be looked at on a historical basis, that is where the P ratio was a few years back, and also on a comparison basis where the company's P ratio is matched against the industry or the sector's P ratio. The second box is the PEG ratio, and if you've seen my video on repeater lynch, this term should require no introduction from me. But just to summarize, if the PEG ratio is above 1, then the company is overvalued, and if it is below 1, then there is some undervaluation to this. The third metric is the earnings yield, and expectedly this number should be higher than the yield on a 10-year Government of India bond, because without that it won't make any sense to invest in an equity instrument. So at the time of recording this video, the yield on the 10-year paper was 7.17%. Correspondingly, the earnings yield, which is nothing but the inverse of the P ratio, well, this number has been quite low for some time now, and I could only find a couple of stocks in our list which were above the 7.17% threshold. The fourth variable is the PB ratio, and Dr. Malik prefers companies where this number is less than 1, and unfortunately none of the companies in our list have such a low price to book value number. Then comes price to sales, and we can see Dr. Malik using a reference from James O'Shaughnessy, who says one should invest in a stock if the price to sales ratio is less than 1.5, and an investor should promptly sell that stock if that number goes above 3. Again, I find that while we don't have many options to invest, we do have a lot of sell candidates. And the sixth and final factor is the dividend yield, and per Dr. Malik, while a dividend yield of 5% is highly desirable, he also advises investors not to focus too much on this number if the company is growing at a fast pace. Alright, so I know what you're thinking. You're saying, ये movie तो बहुत अच्छा चल रहा था, but climax थोड़ा boring हो गया. So you're specifically pointing out to the valuation part where not many companies seem to be fitting in, and we are left with just 1 or 2 stock picks. Actually, 1 or 2 is still good because we've probably nailed down the best and the second best company from a list of 4,000 plus, but here's some useful advice. So as per Dr. Malik, out of the 4 categories, that is financial, business, management and valuations, if there is one category that can be relaxed a bit, then it's the valuation parameter. I mean, look at it this way. The first 3 categories help us identify a fundamentally strong company. So even when the valuation, the price gets a bit expensive, all it means is that we might have to tone down our return expectations. Anyways, I found this checklist to be a good starting point in identifying stocks from a standard screener, and I'll request you to go through the other screener-based strategies that I've explained in previous videos to get a more comprehensive understanding of the metrics and what those numbers are trying to explain. I sincerely hope you found this video useful, and if you've come across some articles, a book perhaps, or some material that explains how other investors think, operate, and identify stocks, then please do share it with me. Once again, thank you for your time. Please like this video, share this video, and I'll see you 3 days from now. Until then.